The bad news is that the Fed has become extremely aggressive and hawkish. The good news is that we are beginning to get data that is confirming that the economy, the U.S. economy, is in recession. And if you've tuned in before, you know that we believe that that Europe and China effectively have been in recession as well. So now a global recession. We're also getting a lot of indicators that prices are coming down. And I think this notion that the inflation that everyone has been worried about is quite a wrong way of looking at the world right now. We believe that deflation is the much bigger risk. We've been saying this for a time. We've been ridiculed for saying it. And we were challenged by those who were sure that we were back into a 70s style inflation scenario. We think that the pricing action, and I'm not just talking about stocks and bonds, I'm talking about commodity prices, crypto prices, and perhaps soon even housing prices, that many people will conclude the greater risk is deflation. And as you know, we don't think deflation is a bad thing per se. It is a bad thing the way the Fed has approached it, we believe. But deflation can be a very good thing if it is caused by technology and progress. And we think we're going to see a lot of that over the years. But right now, we're looking at bad deflation. And we're going to have to get through this. I think the next Fed move is supposed to be at the end of this month. And the Fed is out of its quiet period, so all the Fed governors have been traipsing out, saying we're going 75 basis points, another 75 basis points. Well, we think that they will rethink that in this month as we get not only more pricing signals, but earnings reports and guidance from companies who will be probably confirming that the U.S. is now in recession. So bad news, good news, darkest before the dawn. We called this segment Finding Growth. We think growth is going to be scarce this year. And as you know, innovation is all about growth. Innovation is also about solving problems. We have a lot of problems now. A recession is going to be providing another set of problems. So crypto had its worst quarter since 2011. And it's a much more mature market than it was back then with the boom bust. So that's saying something. The S&P down 20% year to date, NASDAQ down roughly 30%. So the stock market has not seen a worse year to date since 1962. And that was when the Cuban Missile Crisis took place. And then what happened after that is we ended up in the Great Society, guns and butter, and inflation took off. But first, the stock market was a barn burner. It was very hot from 62 to 66. When it comes to bonds, this has been the worst year-to-date performance in bonds in anyone's lifetime. And by some measures, you have to piecemeal the bonds, but to try and get the record, the worst since 1788. That's more than 250 years ago.
The first thing would be to not pull out your money out of the market. And when stock prices begin to fall, it may seem like the logical response is to pull out your money out of the market immediately. And however, that can sometimes do more harm than good. And market volatility may be alarming, but it's normal. Stock prices rise and fall every day, and some days they increase or decrease more than usual. And sometimes they may even fall for several days in a row. And however, that doesn't necessarily mean a crash is coming. And in many cases, stock prices will bounce back as quickly as they fell. And if you sell your stocks after the prices have fallen, and then those stocks immediately recover, you'll miss out on those earnings, you will take a loss, and you will also miss out on a massive opportunity that you could have made money if had you bought the stock. And in addition, when you sell when the prices are lower, you may lose money on your investments by selling for less than you paid for your stocks. And because the market can be unpredictable, no one can know for sure whether a crash is coming until it's already here. And by then, stock prices will have fallen considerably, and withdrawing your money will only lock in your losses. And it's far better than to simply hold your investments regardless of what the market does.
So, or almost 250 years ago. So it's been a very, very rough market for investors. We think there is light at the end of the tunnel. The light is that the Fed is getting a lot of signals that will ultimately end up in the lagging indicators called the PPI and the CPI. They're getting a lot of indicators, and I think a lot of companies are going to be telegraphing in their earnings reports this next month that we are in recession. And I do believe the Fed will do a double take. I want to spend a little time on crypto. It has been an incredible month, and fears of systemic collapse have been rife in the marketplace. So we've seen Bitcoin, it peaked way back in November at 69,000, and it is now at 19,500. It is still higher than its pre-COVID 7,000 to 10,000 range. And it is just about at its 2017 high. So this could be some support. It's also at, it is below its 200-week moving average, which is at 22,500. So there is some concern that that is the new resistance. Now, as we've seen the last month play out, talk about a reach for yield. Crypto personified that. DeFi personified that. And we knew that the Luna Terra experiment with algorithmic stablecoins was not going to work. It was backed by nothing. And I remember we did a podcast with Do Kwon. It's still on our site. And I remember listening to it twice because I couldn't understand what he was doing or saying. I am an economist by background, and so I really do try and noodle through these things. And I just didn't think that was going to work. And it failed in spectacular fashion in May. And has taken Celsius down with it, Voyager Digital, 3 Arrows Capital, BlockFi almost. It was very interesting to see BlockFi's last funding round at $3 billion. This is a lending platform. And tried to do another round recently at $1 billion. He couldn't get it done, and today it seems that FTX is going to buy it out, or it has the option to buy the equity for $240 million. A rumor this week had it at $25 million, so much better than that, but much worse, less than a tenth of its last round. And it's not just happening in crypto. Klarna just announced, I believe, that its last round was in the $45 billion range. This is a fintech company, and it is doing around now at $6.5 billion. So big down rounds happening very quickly.
How rapidly the world is going to change. But Raul said something I thought very important, and it does address an elephant in the room. We know that innovation in the equity markets, the public equity markets, not the private equity markets, has been ravaged in the last year. It's about a year that it has been ravaged. And Raul mentioned that when there is a change in expectations, and last year, as we were getting our vaccinations, the thought that the economy would open up and interest rates would go up, inflation would go up, but would be tamed. During the year, there was a change. The supply chain issues did not go away, and so this fear about what inflation and interest rates are going to do has gripped the market. First, it gripped the innovation space almost exclusively in a puzzling way. Now it seems to be affecting the market a little more broadly. But I will say now that the 2-year Treasury and the market itself has priced in at least 4 interest rate hikes, that this possibility is priced in the equity markets too, increasingly. And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economy. So I think the fears here are going to shift from rising interest rates and higher inflation, potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem. So innovation stocks in the public equity markets are down, I'm going to say broadly, 50 to 75% in the last year.
That's it guys from here today. Thank you so much for watching. Please hit the like button and do subscribe if you haven't already. Thank you so much for watching guys. I hope you all have a good day. And the second thing is, one of the best advices that anyone can give is to focus on quality long-term investments. It's much easier to hold your investments through tough times when your portfolio is full of strong stocks, and healthy companies are more likely to survive volatility, meaning there's a better chance that the stock prices will rebound when the market eventually recovers. And right now is the perfect opportunity to double check all the stocks in your portfolio and to make sure they are still strong investments. And there are several factors that separate strong stocks from weaker ones, including the company's financial history, its leadership team, and its competition within its industry. And keep in mind that the best investments will perform well over several years or even decades. And even if a company isn't as exciting, trendy organization, or isn't experiencing explosive growth, that does not mean it's not a smart investment. By focusing on a stock's long-term potential, you are giving your investments a better chance at surviving a market turbulence. And when you're in doubt, it's always best to stick to index funds, ETFs. Not everyone enjoys researching individual stocks, and that's okay. Another option is to invest in index funds and ETFs, and particularly the S&P 500 ETF. An index ETF is a collection of stocks that tracks a particular stock market index. An S&P 500 ETF then follows the S&P 500 index. That means it includes roughly 500 stocks from some of the largest companies in the US. This means that it includes roughly 500 stocks from some of the largest companies in the US. And historically, the S&P 500 has a 100% success rate when it comes to surviving the market crash. And over the last 20 years alone, it has experienced the dot-com bubble burst, the Great Recession, a global pandemic, and more. Yet despite everything, the S&P 500 is up more than 200% since 2000. So if the market does crash again, there's a very good chance that the S&P 500 index will always recover. And by investing in an S&P 500 ETF that mirrors the index's performance, it's highly likely your investment will recover as well. And stock market crashes can be daunting, but there are ways to prepare for them. While nobody can say for certain whether a downturn is looming, by taking a few steps to strengthen your portfolio, you will always be ready for anything. So these are some of the best advices you can get from any video on YouTube. The first one is always to not sell, to not panic sell. And the second one is always make sure that you're invested in the right companies. Also learn about the companies, what kind of changes in economic factors have on those companies. Suppose a company like Tesla will face a lot of bad times if the economy is doing well, because people are not going to purchase cars when they don't have enough money to survive. So at a time like that, even if Tesla produces the car of the century, nobody is going to buy it, because the most important thing for them is to survive, is to have some money, to save up some money before even thinking about buying a car. So that's how it goes, guys. Thank you so much for watching. Please hit the like button. I'm just trying to get back into the algorithm. Please hit the like button. It really helps. I hope you all have a good day.